Hey everyone, Jordan with the Startup to Scale podcast, and I'm really excited for today. We're kicking off the first of our three-part mini series on finance with Alice Zhang, who's the founder of myPocketCFO. This is going to be a really fun series where we're diving into everything kind of financing for CPG brands. So, for today's first conversation, we're going to be covering financing and capital raising for CPG brands, talking about everything from overall strategy, getting your balance sheet and P&L ready for financing and fundraising, how to tell your company's story through numbers, and the pros and cons of each approach. And so with that, what I would love to do is just do a quick intro of Alice, who's joining us. As I mentioned, she's the founder of myPocketCFO, which is a one-stop platform to make finance management for e-commerce companies simpler. Alice has been serving in a CFO and FP&A planning capacity for Fortune 500 companies and e-commerce startups in the last decade. She's raised 25 million in VC funding and over 10 million in alternative financing before, and she is a McKinsey and Wharton alumni. Alice, welcome.
Thank you, Jordan. Thanks for having me.
I love it. So I'm excited to just jump right in. So I'd love for you to talk about how an e-commerce or kind of emerging CPG founders should think about capital needs and where to get it.
That's a great question to start. So I would say to start with, in terms of a thinking model, I would categorize the ways to finance, including equity finance, into three categories. I would say to start with, that would be self-funding, including friends and family funding, right? So typically when you have an idea, as a founder, you want to work on a very, I would say, on a very focused audience to test out if the idea or concept has legs. In that case, typically you would foot the bill initially by yourself or your family or friends. So that would be the first category. The second category, I would say, I would call commercial financing. And there are a bunch of commercial financing companies out there, and it's very popular nowadays. There are a list of, I would call digital lenders out there, from Shopify, Capital, all the way to Settle, to Wayflyer, you mentioned earlier, and to a number of other ones. For this type of financing, I call them typically it's either cash advance based on a projected future revenue coming in. I would say Shopify Capital is a typical example of that. The second subtype of that would be collateral-based debt financing. I would say companies like Settle, companies like Kickfurther, and a number of other digital lenders. They finance based on either, I would say, like an inventory, a PO of a co-packer or inventory, or they finance based on a collateral like receivables from your wholesaler or retailer, right? So that would be the second category. Typically, it's more short-term financing your day-to-day working capital needs. And typically they charge a market rate of anywhere between 15 to 18 annual percentage rate. The third category, I would call it equity financing. As you all know, we call usually fundraising. Under equity financing, there are also different subtypes. I would say to start with, there's equity crowdfunding platforms like Republic. I know many e-commerce companies go there. And obviously there are angels who write typically safe checks to e-commerce founders. There are also...
Alice, what's a safe agreement?
That's a good question. Actually, it's an acronym. It's almost like I would say a note. They write it to you to, let's say, if I want to invest into Jordan, the bar company you founded, I would basically say, hey, Jordan, I can borrow 25K to you. So I write a note to you, and you can return back in certain time frame. If you have a next round of financing by institutional investor, then that 25K lended money can be converted into equity. So that's a safe note. It's a concept invented by YC, Y Combinator.
I think it stands for Simple Agreement for Future Equity.
There you go. You are expert.
Okay, awesome.
Okay, and then I would say the third subcategory would be institutional, and typically we call VCs, right? Institutional VC investors, obviously they have more muscle in terms of internal resources to carry out more systematic and structured due diligence. And typically they pay more attention to your key financial metrics. They do benchmarking. They do pretty thorough analysis on whether or not your company would be a good fit for them to invest in you for the long-term growth. So those are the three broad categories. Any questions there?
Yeah, and when founders are starting out, about how much money do you see companies putting into their own company, either from their own investment or investors at the very beginning?
That's a good question. I would say it depends on the type of company you're funding. Of all the clients I've served, I have seen where founder and their friends, family put in, somewhere north of 250K or even 350K. There could be a really small amount like 50K put in. So it's a wide range. Really depends on how much extra capital you can afford, right, to put into this experiment, how convicted you are in this idea or concept, and how much you're willing to put out. So it really depends. But I think the parameters you should think about is how much money it will enable me to carry out experiments, whether to say I want to try out with 10 customer or 20 or 30 customers, or get their feedback, or run some survey, or run a batch of test product to test it out. So it's really I would say a founder's call.
I love that you use the language around experiment, because that was a game-changing kind of philosophy that a mentor once taught me. Because as a founder, I thought that when I first started, I need to have all the answers and create the perfect product from the beginning. And as any founder can tell you, your first idea is never perfect, and it's never going to be the long-term idea. And so a very good way of approaching it is by thinking of it as an experiment, so that you have a hypothesis to say, hey, I see this consumer need, and my hypothesis is that we can solve it in this way with this type of product. And the funding that you need at the very beginning, like you mentioned, is designed to run experiments and test. Is that solution going to solve the consumer problem? Does the consumer problem even exist that you think it is, and for how many people? And that gives you the initial kind of traction to know if you have product market fit or not. And as much as you can test it out at the beginning, the higher likelihood that your company has to be successful, right?
Yeah, totally. And think of the capital need. I would say from the investor's perspective. So all those outside investors, from commercial lenders all the way to equity investors, they are they're looking at the risk return ratio, right? So obviously commercial lenders, they're investing in something with, I would say, very low risk and moderate return. And when I say low risk, it means you're posted revenue. So they have the revenue there. They can project with reasonable confidence level, or they have the collateral, meaning they have the receivable, the invoices or the inventories they can collect as a collateral. So overall, it's fairly low risk, and it's moderate return in terms of 15 to 18% annual interest rate you have to pay. And then for equity investors, it's high risk, right? High return, right? So high risk in the sense that for equity type of money, typically they're looking at return in terms of multiples, right? Like a 2x, 3x, all the way to 10x and 100x of the capital they invested. So that's very high return, and they're looking for corresponding risk. So if you, I would say, do reverse engineer, what you need to do as a founder is to show to the investor how I can de-risk my startup business, my ideas, so that the investors feel like it's a good deal, right? So if they're looking for something low risk, you can show them like, this is truly low risk. Look, I have consistently been able to generate, 20K, 30K, 50K each month of my Shopify revenue, and for the past 2 years. That's the risk for commercial lender, right? I show them to, okay, I have consistent invoices to this wholesaler or retailer, and they have been consistently paying me. Again, so that's collateral, and that's the risk. Very similar to equity investors. If you can show to the equity investors, I have put in 50K, 100K of my own money to run the experiment, and all those 30 customers in the pilot experiment loved it, and here are the proofs I can show you. That's the risk, right? So that's why in the beginning, just to experiment, test out the concept, the risk is extremely high, and it might be challenging to get outside outside investors, until you have de-risked it to a certain level. And then you can go there to show the proof and to say, hey, I have de-risked it, and to make them feel more confident that their capital can have the type of return they can expect.
But Alice, talk to so many founders who think I have a great idea and I'm making $1,000 a month at farmers markets. I want to raise $5 million. Why aren't people giving me money?
Right. So, so my advice to the founders is that it's kind of like climbing a staircase. Again, think in a reverse engineer way from the investor's mindset. Don't think from your own mindset, from your own perspective. Try to get into the mindset of an investor. And if you are shooting for an investor who, if you're seeking for, let's say a meal or 2 meal type of investment, think what the mindset of those investors might be looking like. And they would be looking something for how you can de-risk. If they invest in 1 meal, they're probably expecting your revenue, typically, it's 20% of a valuation, right? So to begin with, your valuation should start 5 or 6 meal, or even go up to 10 meal, right? For that kind of valuation, there are certain expected revenue to be generated from your business. So you really need to think from an investor's perspective. What's their risk mindset, risk return mindset, and what's their economics model that they're thinking, and then try to do reverse engineer. That would be overall approach.
I think that's a great way of approaching it. And so a lot of founders will also say like, hey, I know there's these different ways of raising money. What are the pros and cons of each of the approaches?
That's another good question. I would say, again, try to match the characteristics of each approach to your business's nature and business needs, right? Like I said, in the initial proof of concept stage, it's better to put out some of your own money or from your friend's family who know you, who is really investing their money in you and in your idea, and not expecting, I have to get this return, right? So to match the stage with the type of invest to the stage. And then when you are post revenue, when you start selling on Shopify, on Amazon, on wholesaler and retailer, that's where you have amassed some of the assets, I would say, right? Either in terms of expected revenue or assets such as inventory and receivables. So in that case, nowadays, there are widely available digital lenders, digital financing tools out there. And it's easily, you can get those type of financing like right away and a click, pretty much within minutes or hours, right? But those capital, I would say, the pros would be obviously quick and easy money. The cons would be typically it comes in a smaller amount, and as a percentage of your sales or as a percentage of your working capital. So for example, if I would say for digital lenders like Kick Further, they typically, I would say, finance about 10% of your revenue level, similar with Settle. And they also just finance a percentage of your overall outstanding invoices. It could come in, if you have, let's say, 500K revenue, 10% is only 50K. So that may not be a big enough amount. And if you need a bigger amount to really finance your long-term growth, like getting into a new market, getting into a new channel, you may need to go out seek for equity funding, and they could come in, at anywhere, to 250K, 500K, a meal, a few meals. And you can climb the ladder. You don't have to shoot for equity funding right away. That's what I would recommend for the staircase. Go for commercial debt lending first to prove that you can run your daily operations and do some leverage there. And then once you're done that, then in terms of equity funding, go for I would say you could try some crowd equity funding. That might be a good way for you to get your names out there, because those people may not know you, but they may be attracted to the business you run. So that might be good for you to test the water of your business model and just get your names out there. And then next, you could try for angels. Angels, sometimes, again, they may invest in you, may invest in your business. And angels, typically, they could serve as great connectors to introduce you to institutional investors. And angels could serve as a great, I would say, a person to back you up, a believer to support you in raising more funds from institutional investors. That show of support is a great credibility to lend it to you. So so basically, I think that the golden rule is try to match each type of financing tools to your specific business needs. If it's more experiment, if it's more daily, try to match it with more commercial lenders and your own circle's money. If it's more of a proven business model, you're ready, you have a business plan, you have an operating plan to shoot for, to go to the moon, to shoot the stars, then try to build up the supporting, I would say, community, like the angels, the crowdfunding platform. Try to build it up all the way, then which lead to the institutional investor. Does that make sense?
Yeah, I think that's a really great overview in terms of selecting everything. And so now that founders have an idea of what type of financing they might want to go after, a big part is kind of showing your existing business metrics, and you do that through your profit and loss statement, or P&L, or your balance sheet. So how do you actually, as a founder, get your P&L and your balance sheet ready for fundraising?
Yes, so that's the homework and preparation you have to do. And when you refer to fundraising, I suppose that means equity fundraising, right? Equity financing. Let's start with P&L. So I would say step one, you need to get your historical P&L correct and accurate by practicing really good bookkeeping and accounting activities, meaning close your monthly accounting book in time and get all your transactions correctly reflected in the right category in your accounting book, right? That's something actually myPocketCFO, I'm gonna do a plug-in here, myPocketCFO can help you to get the building blocks correct first. Once you have the right building blocks, I would say, what I typically do is I would have a P&L, historical P&L review session with the founders. That's where you look at your historical performance and you try to parse out and see what are the levers you have used in the past and how well those levers worked. For example, by looking at your historical P&L, you should be able to tell, okay, what's the growth rate of my quarter over quarter or year over year of my business in the last, let's say 2 years, right? What is my gross margin looking like? Is it healthy or I have some room to optimize my gross margin? How is my marketing spending and the ROI of my marketing spending looking like in my business? And again, are there any ways I could optimize those? So getting, I would say, sink your teeth into those specific metrics into your historical P&L is a great way to get some insights from what you have done before and have an assessment of how well those inputs in terms of inputs in generating the expected outcome. Once you have that kind of understanding, it's going to greatly help you in building out a forecasting, right? So an investor would always want you to, number one, show their historical P&L, and number two, show them a forecast. To start with, a forecast P&L and in year one, typically at least the year 1 to year 3. So 3 years of forecasting. If you understand how well you did in terms of what are the things you have input in dollar amount and what are the output those input has generated, you're at much better position to do the forecasting in terms of thinking, okay, can I do something to improve the efficiency of my marketing dollar spent? Can I do something to improve my gross margin? Can I do something to accelerate my growth? Maybe by developing, by going into more national chains instead of or on top of independent stores, for example, right? Or can I accelerate my Shopify and Amazon by optimizing some of the gross marketing tactics? So anyway, so that would be something. Look at your historical P&L, try to extrapolate out the levers and how much improvement you can do those levers, try to extrapolate out into projecting your future P&L. So, and that would, I would say that would be the core the investor would be looking at, historical P&L and forecasting model for the next 1 to 3 years. And when it comes to balance sheet, I would say investors typically just look for one thing in the balance sheet. They're looking for, is there something, some abnormal debt on your balance sheet that they should be aware of? As you know, equity money comes after you have to pay off the debt. So that's why it's more of a risk control factor that they look at your balance sheet to understand if you have any debt financing, how much of that debt financing you have. Is that high enough to pose as a risk to equity owners?
No, those are all really great points. And I feel like a lot of founders get scared by their financials because they don't fully understand them. And it leads to a problem of them doing it incorrectly if they're doing it themselves. And that's not good. So I always recommend they get help by working with someone like my Pocket CFO or working with an accountant that they have to make sure that it's telling the right story, because most founders will just like give investors all the information, and that also leads to more problems. I just remember one time I sat down with a potential investor and I printed off our sales by week for the entire year, and this is in our first 2 years of business, and every week the sales went up and down and up and down, but that looked worrying to the investor because they're like, whoa, why are your sales down in September compared to August? It's like, well, the Whole Foods buyer was out sick and they bought a lot the month before, so we didn't sell any this month. And it just made for like a really rocky financial picture, versus if we showed our numbers in like a quarterly view, then it would have told more like the trend line for our growth story. And so it really help me understand that your numbers, while both situations, both sets of numbers were true and accurate, how I presented those numbers told a different story. And so I'd love to hear from your perspective, how you help companies use their numbers to tell a compelling story.
That's a great question. I love that question. And before I talk about how to build your story using the financial numbers, I would say, yeah, never share your weekly numbers with the investor. That's almost always, it would be a noise than a signal to any type of investor, right? What I would recommend to all my clients is, especially an early stage, I would say pre-Series A stage, a quarterly, both in terms of historical P&L and forecast P&L, quarterly P&L would serve the purpose. Don't even go to monthly. You could do internally on a monthly basis, but share quarterly is enough to show the trend line. Like you said, it's all about the message you send in a very concise, clear, and simple way. Like, don't add unnecessary details to distract the investors, right? So that's just a simple tactical advice, is stick to quarterly.
Yeah, definitely true.
Yeah, okay. And then in terms of how to build your story, right? It's great. And I have been doing that pretty much for the last decade since my McKinsey days. It's all about storytelling. I would say, think of the way as the numbers is a result. The numbers is almost just like a dot, on a piece of paper, on a blank sheet of paper, right? It's just the end result. What you need to add and weave into those numbers is to give the context of how those numbers can be, linked together to show a trend line, right? What are the colors of those numbers? How you achieve those numbers? Everyone achieve those numbers in their own unique way. Like, multiple passes could lead to the same number. So that's where actually I think you should view it as an opportunity to tell the full story, of a colorful story of a hero's journey, right? We always say every founder is a hero's journey story. So think of that, how you can tell your hero's journey to the investors by enriching that number with a lot of context, a lot of color in terms of, okay, I made, 1 million sale of last year. How did I do that? And, how, for example, how fast I reached to that 1 million in the past 2 years. So that's the way you could link multiple numbers. You could say my growth rate for the past 2 years is like double every year, right? So you give more context to that number. The other thing is, like, I achieved, I would say I spend only 20% as marketing spend as percentage of revenue, but I drive 2x revenue. So you need to link those numbers together to tell where you start, what was your intention, where you want to drive towards, and this is the outcome it shows, right? So those are, so first, I would say first step is see those numbers as all connected, and see those, put those numbers into, I would say, into 3 boxes. One is, what are the input? What are the input numbers? Meaning, what are your spending, right? Like you put some input into the input box. What are the numbers there? And then there's the output number in terms of your sales, your some of the metrics, your gross margin, your operating margin, those kind of things, right? So the input number, the output number, and the blank box is where you can explain how you drive that. What's your intention? What's the efficiency? How effective it is? So that's the first layer, more technical, right? And then I would say more sophisticated founders, they would layer on top of that technical explanation, they would layer it with more qualified, I would say qualified characteristics or attributes. When I say qualified, meaning it may not be measurable, but they would tell something about their background. You know, I have 10 years of working with retailers, wholesalers. I worked with Whole Foods in my previous job. Therefore, you know, like my trade spend efficiency is much higher because I have some like deep know-how. So like blend your personal edges or advantages or expertise into those numbers to show this is the know-how you have. This is a unique advantage you have in driving those numbers, right? If it's a relatively not so good number, explain why. You know, that's very important. It's not about what. It's always about how you did that and why, right? So I think that the more sophisticated and probably better storytellers, they would blend those more personal stories and about their background, their specialties, or some industry specifics, know-how, like insights into those numbers. And that story, you know, would be a blend of science and art. Always, you know, works better because it connects with people both on the emotional side as well as on the more logical side. I hope that makes sense.
It totally does. And I think that was perfect. Alice, this has been so much fun for our first episode. There's so much really great information and content, both from a strategic level and from a very tactical level. So I really appreciate you being on. For our founders listening, be sure to check out our second episode that's going to be released on Wednesday. If you're listening to this live, or if you're listening to it later, you'll see the episode number 2 in our microfinance series. For anyone interested in getting in touch with Alice, feel free to check out myPocketCFO. And for our listeners, she's offering a special discount where you can actually try their auto bookkeeping for an introductory price of $99 for 3 months. And then it's just $199 per month after. To get that, feel free to shoot Alice a email. We'll put that in the show notes. And she'll also share the working capital financing option list, which is a breakdown of different companies, their rates, and which ones might be a good fit for your business, and also a fundraising checklist. So Alice, thanks so much for today's episode, and looking forward to having you on the next one.
Thank you, Jordan. It's really fun, and I look forward to the next episode.